Welcome to the Deep Dive, where we cut through the noise and really immerse ourselves in the kind of detailed analysis that gets you truly well-informed fast.
Exactly. We go deep so you don't have to.
Today, we're plunging into a name that, well, it's almost synonymous with financial identity for millions of people, FICO.
Fair Isaac Corporation.
Yeah, this isn't just any company. For so many people, FICO is their credit score. It's fundamental. And what makes FICO particularly fascinating right now is this kind of paradox it presents.
A real duality, yeah.
On one hand, they're announcing absolutely stellar financial results. I mean, remarkable growth, operational efficiency, the whole 9 yards.
Just knocking it out of the park, numbers-wise.
But on the other hand, they're navigating some pretty significant regulatory headwinds. These are fundamentally challenging its, long-held dominance, especially in the critical U.S. mortgage market.
It's truly a classic case, isn't it? A powerful incumbent, operating at two distinct speeds. Well, you've got this really robust internal performance, right? Driven by its market-leading products. But that's meeting this very real, very external pressure from regulators and, frankly, emerging competitors.
Right.
So understanding how FICO manages this duality, this tension, and what it means for its future, well, that's key to our deep dive today.
Absolutely. Our mission today is clear. We're going to unpack FICO's latest Q3 fiscal 2025 earnings report. That gives us a window into its current health.
The hard numbers.
Exactly. Then we'll peel back the layers, understand the deep foundations of its core business, explore how it built such an impressive competitive moat.
That famous FICO moat.
Then we'll dive deep into the significant regulatory shifts that are shaking things up in the mortgage market, particularly that FHFA lender choice decision we have to talk about.
Oh, absolutely. That's huge.
Finally, we'll explore what all of this, the financial triumphs, the regulatory challenges, FICO's strategic responses, what it all means for its future trajectory.
And crucially for you, right? Whether you're a consumer trying to understand your credit, maybe a lender navigating these new rules, or perhaps an investor tracking a complex but undoubtedly powerful company.
Exactly.
And to guide our exploration today, we've pulled from a pretty comprehensive stack of recent reports and direct commentary.
What are we looking at?
We've got FICO's own Q3 financial statements, of course, for the raw numbers, then insightful analyses from places like investing.com and TradingView.
Oh.
We've also drawn from more specialized investor newsletters, Summit Stocks, Darius Dark Investing, Aria Substack. They often provide some really nuanced perspective.
Good stuff.
And importantly, to get it straight from the horse's mouth, we've incorporated direct commentary from FICO CEO Will Lansing. He did a Bloomberg television interview recently.
Oh, excellent.
Plus, we've got broader market perspectives from super investors, discussed on platforms like Joseph Carlson After Hours and Buyback Capital. So a good mix.
Sounds like a solid base. All right, let's get into it. Okay, let's start by looking at the numbers then, because FICO just released its Q3 fiscal 2025 results. And wow, they are, by almost any measure, seriously impressive.
Yeah, they really stand out.
We're talking reported net income soaring to $181.8 million for the quarter.
Which is a huge jump from the prior year, right?
Exactly, a substantial increase from $126.3 million in the prior year period. And their diluted earnings per share, the EPS, hit $7.40.
$7.40.
Yeah, marking a significant jump from $5.05 per share year over year. These aren't like minor tweaks. They represent really robust double-digit growth.
And, a key insight here is often looking at the distinction between GAAP and non-GAAP figures.
Right, the adjusted numbers.
Yeah, because they can offer a more complete picture of a company's sort of operational performance. GAAP, generally accepted accounting principles, gives you that standardized view.
The official accounting.
Right. But non-GAAP often strips out certain non-recurring or non-cash accounting entries, things like stock-based compensation or amortization.
To show what? The core profitability.
Exactly, the underlying profitability from core operations. And for FICO, their non-GAAP net income was $210.6 million.
Also up significantly.
Way up, with non-GAAP EPS of $8.57 compared to $156.4 million and $6.25 per share, respectively, in the prior year.
So strong growth across both metrics then.
Yes, and that's the key. The consistent and strong growth across both metrics, GAAP and non-GAAP, it just signals a genuinely strong quarter. It's not just, accounting tricks. It's not just top-line growth either. It speaks to improved efficiency and a really healthy operational core. Those non-GAAP numbers often reflect the actual cash-generating power of the business more directly.
Okay, makes sense. And looking at that top line, total revenue for the quarter was $536.4 million.
Which, again, is a big jump.
A robust 20% increase from $447.8 million in the previous year. I mean, achieving 20% growth at FICO scale, especially in, well, this kind of dynamic economic environment, that really stands out, doesn't it?
It really does. This revenue growth isn't just a statistic. It underscores FICO's ability to maintain, maybe even accelerate demand for its products and services. When you see such a significant increase, it's a powerful indicator of their market position and, the continued reliance placed upon their scores and software by financial institutions.
Even with higher interest rates and maybe some uncertainty.
Even then, it speaks to the kind of essential nature of what they provide. It's deeply embedded.
Now, here's a particularly striking detail you pointed out earlier, that 20% revenue jump. It wasn't evenly spread across their business segments at all.
Not at all. One segment was just the undeniable engine room.
The scores segment, right? That's what most of us think of when we hear FICO.
Yeah.
It truly led the charge.
Absolutely blew the doors off. Scores revenue surged to $324.3 million. That's a remarkable 34% year-over-year increase. I mean, that's phenomenal acceleration for such a mature and dominant product line.
34%. So what's driving that? How do they accelerate like that?
Well, the question then becomes, right, what precisely is driving such an impressive acceleration? Our sources point to a few critical factors.
Right.
Firstly, FICO demonstrated its pricing power. They got a higher unit price for their scores, so they're commanding more for each score sold.
Just raising prices.
Essentially, yeah. Secondly, and this is very significant, there was an increased volume of mortgage originations.
Mortgages.
Which saw a substantial 53% year-over-year increase in volume contributing to FICO's revenue.
53%.
Yeah.
But haven't mortgage rates been high?
They have, but this suggests that maybe the specific part of the market FICO serves, or perhaps refinancing activity, or just the underlying need for scores remained strong, maybe even grew.
Interesting. Okay, what else?
Lastly, there was a multi-year U.S. license renewal, specifically for their insurance score product. That provided another healthy boost.
So multiple levers then.
Exactly. This diversified set of contributors, pricing power, volume in a key sector, strategic renewals, it paints a picture of a really resilient and strategically managed segment.
And delving a bit deeper into that score segment, the breakdown between B2B and B2C is quite telling, isn't it?
It really is. Business to business, or B2B, revenue increased by a whopping 42%.
32%.
Which almost overshadows the business to consumer, B2C, revenue. That grew by a much more modest 6%.
Okay, so institutions are where the action is.
Definitely. And management specifically noted that mortgage originations revenue accounted for roughly half of that huge B2B scores revenue number.
Half of it from mortgages.
Yeah. So what does this disparity and this heavy reliance on B2B mortgage volume really tell us about FICO's strategic focus and its market leverage?
Good question. What's the takeaway?
Well, this disparity highlights a crucial aspect of FICO's business model, I think. While you, as a consumer, interact with your FICO score, right?
Yeah, checking it online.
The real financial power, the significant revenue drivers, they come from FICO's deep institutional relationships with lenders, insurers, other financial entities. That's the B2B side.
Right.
The 42% B2B growth, heavily weighted by mortgage originations, it just underscores FICO's deeply entrenched, almost indispensable role within the financial industry's back office infrastructure. It's plumbing.
Essential plumbing.
Exactly. It means that despite maybe broader market conditions, the specific demand for FICO scores in this institutional sector remains incredibly strong, and they're highly effective at capturing that value. It speaks directly to that moat we often discuss.
Okay. So while scores are flying high, delivering these stellar results,
Yeah.
the software segment seems to be, well, chugging along at a more modest pace.
That's a good way to put it, chugging along. In contrast to the explosive growth in scores, the software segment showed a much more subdued 3% increase year over year,
Only 3%.
bringing in $212.1 million. And this increase, they said, was primarily attributed to higher software as a service, or SaaS, revenue.
So the recurring revenue part is growing at least.
Indeed. The software annual recurring revenue, or ARR, at the end of the quarter was up 4% year over year, which is positive, obviously. Any growth is good. But
Right.
this rate doesn't match the rapid acceleration we just saw in scores, right? 34% versus 4%.
Big difference.
And it also doesn't quite align with the rapid expansion rates you often see with, say, high-growth SaaS peers in the broader market.
Right. Other software companies are growing much faster.
Many are, yeah. This suggests that while FICO software offerings are valuable, clearly profitable, and contribute meaningfully to revenue, this segment faces a different set of growth dynamics, maybe more competitive pressures compared to its dominant scoring business.
You should definitely dig into that later, what's going on there.
Agreed. We'll circle back to software.
Okay, moving beyond just revenue and segments, let's zoom out again. Look at the broader picture of FICO's profitability and, crucially, its cash generation.
Always important.
Adjusted EBITDA. That's a key measure of operational profitability, right? Strips out some non-cash stuff.
Depreciation, amortization, taxes, interest.
Yeah. It reached an impressive $312.3 million in Q3 2025.
Which is another big jump. A substantial 32% increase from the same period last year.
And their non-GAAP operating margin stood at 57%.
57%. That's really high.
And it's a solid 5 percentage point improvement year over year.
These figures, they really highlight FICO's exceptional operational leverage and efficiency. That significant improvement in operating margin, climbing 5 points, demonstrates their strong ability to manage costs relative to their expanding revenue.
Getting more profit from each dollar of sales.
Basically, yes. Their non-GAAP net margin also held steady at 39%, up 4 percentage points from the prior year, again underscoring robust profitability.
For you, as an observer of the company's financial health, these are very strong signals. It's a business that's not just growing, but becoming more profitable as it grows.
And crucially, for any company's long-term health and flexibility, their free cash flow. How did that look? Free cash flow. That saw a significant rise, reach $276.2 million.
Compared to
$205.7 million in the prior year period. They noted this marked a record for FICO.
a record free cash flow quarter.
Yep. And it represented a substantial recovery from Q2's $65.5 million, which was lower. So a big rebound and a record.
That's a lot of spare cash being generated.
Absolutely. And that strong increase in free cash flow, hitting a record $276 million, is particularly noteworthy for you as a long-term investor or observer.
Why specifically?
Because it's essentially the spare cash FICO has left over after running its business, paying for investments, capital expenditures, and it gives them immense flexibility.
To do what?
Well, whether that's investing in new technology, strategically paying down debt, or generously rewarding shareholders through buybacks, which we'll definitely discuss later, it just signals a very healthy underlying business generating capital efficiently. This substantial cash flow is really a bedrock of FICO's financial strength. It gives them significant strategic optionality. Options are good.
Options are definitely good. So with all these impressive financial results, what's the read on management's confidence? Did the CEO sound upbeat?
Very much so. CEO Will Lansing commented on the results, stating, quote, "In our third fiscal quarter, we again delivered strong results with revenue growth of 20% and even stronger earnings growth. We are pleased to announce that we are raising our full-year guidance."
Raising guidance. Always a good sign.
Usually is. And this isn't just a slight adjustment either. FICO updated its guidance for fiscal 2025 across the board on the profit side.
Okay, what are the specifics?
For GAAP net income, they're now expecting $630 million. That's a bump up from the previous guidance of $624 million.
Okay.
GAAP EPS is projected at $25.66, up from $25.05.
And the non-GAAP?
On the non-GAAP side, net income is now projected to be $718 million, up from $712 million, and non-GAAP EPS rising to $29.15 from $28.58.
So clear upward revisions in profit expectations.
Exactly. Clear signals of increased optimism from management about their ability to execute and deliver against their financial targets, especially on the bottom line. They feel good about margins.
What's particularly interesting, though, is that their total revenue guidance that remained unchanged at $1.98 billion for the full year.
That is interesting.
So if Q3 was so strong and they raised profit guidance but kept revenue guidance flat, that effectively implies a sequential decline in Q4 revenue, doesn't it, to around $505 million.
Mathematically, yes, it seems to imply that.
So why would they expect a dip after such a strong Q3, especially when they're boosting the profit outlook? Seems counterintuitive.
It's a shrewd observation, and it brings up an important point about the, let's say, cadence of FICO's business.
Yeah.
Management did address this. They attributed this implied sequential decline to several factors.
Such as?
Firstly, lower point-in-time revenues. Things like those insurance score licenses or software licenses we mentioned. They can be lumpy, right? Not evenly distributed across quarters.
Okay, timing of deals.
Exactly. Secondly, they cited normal seasonality in score originations, which often sees fluctuations throughout the year. Maybe Q4 is typically a bit slower.
Standard seasonal patterns.
And finally, they flagged some planned higher marketing spending, maybe increased interest expense, and some one-time items exceeding $10 million that are anticipated in Q4.
Ah, okay. So planned costs hitting Q4.
Right. So while the revenue target for the full year remains ambitious, the path to get there factors in these, typical business fluctuations and strategic investments. It seems like a practical and transparent approach to guidance, actually.
Okay. So wrapping up this first section on financials, what's the overall takeaway from FICO's Q3 performance?
I think despite some expected Q4 seasonality and that more modest growth in the software segment, management is clearly confident in the underlying strength of the core business, especially scores.
Yeah, boosting profit guidance while keeping revenue flat says a lot about margins.
It really does. It speaks volumes about their margin improvements and efficient operations. It paints a picture of a business that is not only robust, but also becoming increasingly adept at translating revenue into solid profits. Strong quarter overall.
Okay, let's shift gears a bit. For many of us, like we said, FICO isn't just a company. It is our credit score. It's just this fundamental part of our financial lives.
Almost like a utility.
Exactly. But how did FICO, Fair Isaac Corporation, become so incredibly dominant in the financial world, practically synonymous with creditworthiness for an entire nation? It wasn't an overnight thing, was it?
Definitely not. Decades in the making. FICO, at its heart, is a global leader in analytics software, but its primary fame, and indeed its immense influence, stems from developing and selling the credit scoring models that are so widely used by lenders to assess an individual's creditworthiness.
How widely used?
Extremely widely. But the history of their dominance, particularly here in the U.S., is truly foundational to the structure of our financial system. It goes back decades.
And it wasn't solely organic market adoption that sealed their position, right?
Yeah.
There was a pivotal regulatory moment that essentially cemented FICO's place as the industry standard, particularly for mortgages.
Exactly. That's the crucial piece for mortgages. The game changer occurred back in 1994.
What happened then?
That's when the government-sponsored enterprises, the GSEs, Fannie Mae and Freddie Mac, mandated the use of the FICO score for all mortgages they purchased or guaranteed.
Mandated. So lenders had to use it if they wanted to sell loans to Fannie or Freddie.
Precisely. This was a monumental decision. It effectively established FICO as the undisputed standard for mortgage lending in the conforming market.
And that mandate stuck.
It did. It wasn't a one-time event either. It was explicitly reaffirmed by the Federal Housing Finance Agency, the FHFA, the regulator, just recently in 2022.
Wow.
Further solidifying FICO's deeply entrenched position in that massive mortgage ecosystem.
This deep entrenchment, then, it raises an important question for you as an observer.
Right.
What truly gives FICO such an impressive competitive moat? You hear that term a lot with FICO.
We do.
It's clearly more than just a widely used product. It feels like an entire ecosystem that makes it incredibly difficult to dislodge.
Absolutely. That's the right way to think about it, an ecosystem. FICO scores are often referred to as the lingua franca of credit.
The common language.
The common language, the universal standard by which credit risk is assessed, at least historically. They're widely used by approximately 90% of top U.S. lenders. So virtually every major bank and financial institution relies on them in some capacity.
20%.
But it goes much deeper than just the lenders using them for origination.
How so?
These scores are intricately integrated into risk models across a vast network. It includes not just the lenders originating the loans, but also mortgage insurers who rely on the scores, securitization investors who buy bundles of mortgages based on the scores of the underlying loans.
Right, the whole secondary market.
Exactly. And even the regulators overseeing the entire system use FICO as a benchmark. This creates a deeply embedded systemic reliance on FICO's analytics. It's a powerful network effect that's just incredibly difficult for any competitor to replicate or truly challenge.
It sounds incredibly sticky.
Extremely sticky. CEO Will Lansing himself emphasizes that FICO has been, quote, delivering really highly predictive results for a very long time, which he argues has fostered tremendous efficiencies throughout the financial system. It's a testament to the perceived accuracy, reliability, and just the sheer breadth of their model's usage.
And it's important to note, right, it's not just about these government mandates for mortgages. It seems the market itself has chosen FICO for other types of lending, too.
Precisely. This is a crucial distinction, and FICO makes this point often. While the GSE mandate is undeniably significant for mortgages, in most other sectors where FICO scores are used, think auto loans, credit cards, personal loans, even business lending, there is no government mandate.
So lenders choose FICO freely there.
Yes. The scores are adopted by the free market based purely on their perceived value, their accuracy, and the efficiencies they bring to credit risk assessment. That organic, market-driven adoption speaks volumes about their quality, the trust placed in them, and their proven predictive power over decades. Lenders choose FICO because they believe it works, not just because they have to in those segments.
Okay. So FICO isn't just sitting back and resting on its laurels despite this formidable moat, right? They seem to be actively innovating to maintain their edge and adapt to, well, new financial behaviors and data streams.
That's right. They have to keep evolving. FICO is continuously evolving its scoring models to enhance their predictive power. Their latest major innovation is the FICO Score 10T.
10T. What does the T stand for?
The T stands for trended data.
Trended data. Explain that.
This model is a significant advancement because it incorporates historical payment behavior over time. It looks at how your balances and payments have changed over many months, maybe even years.
Instead of just a snapshot.
Exactly. Rather than just a snapshot of your credit file at a single point in time, it provides a much richer, more dynamic, and hopefully more predictive view of a borrower's financial habits and risk profile.
Does it look at, like, if you're paying down debt consistently?
Things like that, yes. Directionality of balances, payment history trends. It's more nuanced.
And is it gaining traction? Are lenders actually using it?
It seems so. The reports say over 30 mortgage lenders are actively using FICO 10T already.
30 lenders. Okay.
And FICO has secured agreements with institutions representing more than $313 billion in annualized mortgage originations using this new score.
That's a big number.
And $1.52 trillion in mortgage portfolios under servicing with this new score. So yeah, it's getting adopted. CEO Lansing has been very clear, emphasizing FICO 10T's predictive superiority as the key driver for this adoption.
The argument being it's just a better score.
That's the argument.
Right.
Lenders want the most accurate tools, and FICO is making a strong case that this is it.
And they're also looking at newer forms of credit like buy now, pay later.
Yes, they are. FICO is strategically expanding its utility into emerging areas of consumer finance, showing adaptability. They've unveiled FICO Score 10 BNPL and FICO Score 10T BNPL.
Okay, specifically for buy now, pay later.
These are the first major credit scores specifically designed to incorporate that buy now, pay later data, which has just exploded in popularity, right?
Definitely. It's everywhere.
Initially, FICO says these new BNPL scores will be offered at no additional fee.
Free. Why?
Well, it's likely a clever strategic move to encourage uptake, get lenders and bureaus comfortable using it, and integrate this new form of credit behavior into their established ecosystem without a cost barrier initially.
Get it embedded first, then maybe charge later.
Perhaps. It reflects FICO's proactive approach to expand its utility and market capture by adapting to new financial products and data sources. They want to ensure their scores remain relevant and comprehensive for the modern consumer landscape.
Okay, now let's turn to, well, the elephant in the room.
The big one.
Despite FICO's formidable financial strength, that deep market position we just discussed, a very recent regulatory move has sent significant ripples, maybe even waves, through the industry. And it definitely rattled investors.
Understandably so.
This isn't just some minor tweak in the rules. It feels like a potential game changer for the mortgage market.
It really does. In late July, the FHFA, the Federal Housing Finance Agency, remember, they oversee Fannie Mae and Freddie Mac, announced a significant policy shift.
What did they announce?
They declared that lenders delivering mortgages to Fannie Mae or Freddie Mac may now choose between using FICO and VantageScore credit scores.
Choose. So FICO is no longer the only option mandated for GSE loans.
Correct. This is momentous because it introduces, for the first time in decades, direct competition to FICO in the conforming mortgage market. That's the sector where FICO enjoyed that near monopoly thanks to the mandates.
And investors immediately reacted how?
Negatively. For investors, this immediately raised questions about FICO's long-term pricing power and its market share in that crucial mortgage segment.
And the stock took a hit.
It did. The market reacted immediately and sharply. The mere suggestion of moving away from that FICO-only world to allowing competition made investors incredibly nervous. FICO's stock tumbled 8% on the day of the news.
8% in a day is significant for a company like FICO.
It is, and reports noted it was down 23% year-to-date around the time of that announcement. That's a big move reflecting real concern.
You mentioned earlier the tri-merge system. Can you quickly explain what that was again and why allowing an alternative score like VantageScore would cause such a stir beyond just competition?
Sure. Historically, the tri-merge system was standard practice for mortgages. Lenders would pull credit data from all three major credit bureaus, Experian, Equifax, TransUnion.
All three.
Yes. Then they'd apply FICO's analytics, its scoring algorithm, to that combined and comprehensive data set to produce a single, highly robust, widely accepted FICO score for mortgage qualification. It was a standardized, deeply integrated process across the industry. Moving away from the system, or even just allowing an alternative score that might use different data inputs or a different number of bureaus, well, it disrupts that established workflow. It creates complexity.
So it's not just about the score, but the whole process.
Exactly. If we connect this to the bigger picture, this isn't just about offering an alternative score model, it's about potentially reshaping the entire underlying infrastructure of the U.S. mortgage market. That's a massive undertaking with lots of potential friction points.
And the FHFA director seems keen on pushing this.
It appears so. The director, Bill Polt, has been quite vocal about wanting to move quickly to lower costs for homeowners. And FICO's pricing, particularly the increases we discussed, has been framed as a target for this initiative.
This feels like a big shift from where things were earlier this year, right? Didn't FHFA put some other credit reporting changes on hold?
That's a really important point of context, yes. Prior to this latest lender choice announcement, an earlier FHFA initiative was looking to transition to a bi-merged credit report, still using FICO, but maybe only 2 bureaus instead of 3.
Okay.
But that timeline was put on hold indefinitely back during FICO's Q1 2025 earnings call. At the time, that was seen as a definite win for FICO and the lending ecosystem, suggesting resistance to change.
But this new lender choice decision overrides that.
It seems to supersede it entirely in terms of competitive implications. It escalates the stakes significantly and introduces a far greater degree of competitive uncertainty for FICO in mortgages.
Okay. So if lenders now have a choice, FICO Classic or VantageScore, the natural and critical question for everyone involved, lenders, consumers, investors, is which score is actually better?
The million-dollar question, right? Or maybe the multi-trillion-dollar question given the size of the mortgage market.
FICO CEO Will Lansing naturally has a very strong opinion on this. He's not exactly neutral.
He certainly isn't, and he hasn't been shy about expressing it. Will Lansing staunchly asserts that FICO 10T, their latest model using that trended data we discussed,
Right, the more advanced one.
is unequivocally the most predictive score in the marketplace. Full stop.
And how does he back that up?
He supports this by highlighting FICO's extensive track record. He cited, for instance, $300 billion in originations already completed using FICO 20, an earlier advanced model in the non-conforming mortgage market. That's outside the GSE system.
Showing it works in the real world.
Exactly. A testament to its real-world effectiveness and accuracy, he argues.
He also pointed out something specific about the FHFA's announcement, didn't he? About which FICO score they chose to allow alongside VantageScore.
Yes, and this is a rather significant point of contention for FICO. Lansing noted that a previous evaluation process by Fannie and Freddie themselves years ago had actually resulted in a recommendation to use FICO 20 alongside VantageScore, FICO 20 being one of their more advanced models at the time.
Okay, so the GSEs preferred FICO 20.
That's FICO's assertion based on that older evaluation. However, the most recent FHFA pronouncement, the one enabling lender choice, specifies the use of FICO Classic and VantageScore.
FICO Classic, that sounds like an older version.
It is generally considered an older, less sophisticated model compared to FICO 10T or even FICO 20. And Lansing stated, quite pointedly, that FICO Classic and VantageScore perform roughly the same in terms of predictiveness.
Implying the FHFA chose a less predictive FICO score to put up against VantageScore.
That certainly seems to be FICO's implication. It feels like a strategic point they're highlighting. Why not allow our best, most predictive score, FICO 10T, if predictiveness is the goal?
So Lansing's core argument is that their newer scores are just better.
Yes. His key argument, and where FICO sees the greatest concern, is that FICO 20, and by extension the even newer FICO 10T, significantly outperforms VantageScore.
Significantly how?
FICO's internal analysis, which they've referenced publicly, suggests that this superior predictiveness would lead to demonstrably lower credit defaults. And interestingly, it would also qualify 5% more borrowers who are genuinely creditworthy.
So safer loans and broader access.
That's the claim, thereby expanding access to credit safely. This is a direct and impactful challenge to the FHFA's choice of FICO Classic over their more advanced models. They're essentially saying, you're not choosing our best, the one that was already evaluated positively, and that has negative consequences for both risk and access.
And on the other side of this predictiveness debate, FICO's CEO has also raised some pretty pointed concerns about VantageScore's approach itself. He used terms like much looser, more lax credit standards.
He did. He's been quite direct in his critique.
Can you elaborate on the specifics? What's his issue with VantageScore's methods?
Certainly. Lansing highlighted a key difference in their methodologies based on FICO's understanding. He cited examples like VantageScore apparently being able to generate a score based on only 1 month of credit data.
Just 1 month.
That's the claim. Whereas FICO, to ensure what they see as a more robust and reliable assessment, requires a minimum of 6 months of data history.
6 months versus 1 month.
Right. His powerful analogy was, you can't draw a line with one data point, implying that a single month just isn't sufficient to accurately assess long-term credit behavior or predict future risk. FICO's perspective is clear. A longer data history provides a more stable and accurate risk assessment.
Are there other differences they point out, like alternative data?
Well, both FICO 10T and VantageScore do incorporate alternative data like rent history, which is conceptually a positive step, right? Helps those with thin credit files.
Yeah, that seems good.
But FICO points out a practical limitation. There's just not a lot of rental data consistently reported by landlords to the credit bureaus. So its actual impact on credit files today, while potentially good in theory, might be limited in the real world due to data availability.
Okay.
So the core of FICO's argument remains centered on predictiveness. Their models, they claim, have consistently proven to be more accurate over time, leading to better outcomes for the system as a whole, managing risk for lenders, and they argue more equitably extending credit to deserving borrowers.
Beyond the specifics of score predictiveness, though, FICO's CEO also voiced a very serious concern about the broader implications of this lender choice decision, particularly this idea of a race to the bottom.
Yes, this is a significant concern they've raised, and it brings up a fundamental economic principle, the potential for moral hazard.
Moral hazard.
Meaning, if the entity making a decision doesn't bear the full consequences of that decision, their incentives might change. Will Lansing posits that if lenders are given a choice between different score systems, FICO or VantageScore,
Right.
and the ultimate risk of default is largely passed on to the GSEs, Fannie and Freddie, and then potentially to the U.S. taxpayer.
Because the GSEs guarantee the loans.
Exactly. Then the incentive structure for the lender becomes distorted. Lenders might then be motivated, he warns, to shop for the most lax score, the one that approves more loans easily rather than the most predictive score, simply to boost origination volume, even if those loans carry higher underlying risk.
Because they aren't holding all the risk themselves.
Precisely. This suggests a profound systemic risk concern from FICO's perspective. They're framing it as prioritizing safety and soundness of the entire financial system over what they might view as potentially superficial competition based on less predictive metrics.
And he argues that the ripple effect of such a race to the bottom wouldn't stop there. It would have broader negative consequences.
He absolutely does. Such an outcome, Lansing argues, would inevitably lead to more credit defaults across the massive mortgage portfolio held or guaranteed by the GSEs.
Which regulators wouldn't like.
Exactly. In response to this heightened risk, he believes it would trigger higher capital requirements from the regulators for banks and other financial institutions holding mortgage risk.
Making it more expensive to lend.
Right. And ultimately, these increased costs and heightened risk aversion would translate directly into higher rates and fewer mortgages for consumers.
So the opposite of what the FHFA director says he wants.
Ironically, yes. From FICO's viewpoint, what starts as an attempt to introduce competition and potentially lower costs could paradoxically lead to a less stable, more expensive, and less accessible mortgage market for the very homeowners the FHFA aims to help. It's a potential cascading effect that underscores the intricate and delicate balance of the whole housing finance system.
Wow. Okay, so that's the predictiveness and systemic risk argument. But beyond the choice of scores, FICO's pricing itself has also drawn significant fire from regulators, hasn't it? Critics point to substantial increases over the years, especially for that mortgage score.
This issue of pricing certainly raises an important question, particularly given FICO's dominant market position. It's a focal point.
Yeah.
The FHFA director, as we mentioned, has been quite vocal about FICO's pricing model, specifically stating a desire to lower cost for homeowners. He clearly sees FICO's recent price increases as a target for this initiative.
And the numbers cited are pretty stark.
Critics note that the price for a single FICO mortgage score has reportedly risen from sub $1 back in the 2018-2019 timeframe to almost $5 today.
Sub $1 to almost $5. That is a significant percentage increase over just a few years.
It is, and that percentage jump catches attention.
FICO, however, has a robust defense on this point, don't they? They frame it more as a matter of value, not just cost.
They do. CEO Lansing argues passionately that the FICO score represents incredible value. He points out that it costs just $4.95 out of what he says is approximately $6,000 in total closing costs for a typical mortgage.
So a tiny fraction of the total cost.
That's his argument. He emphatically stated, quote, "It's a bargain," and even went so far as to say if FICO were to give it away for free, it wouldn't change anyone's costs in any meaningful way on their mortgage payment.
It sounds like they believe the focus on the percentage increase is unfair, given the small absolute dollar amount relative to the overall transaction.
Indeed. FICO maintains that it intends to continue closing a value gap, meaning they think their score is still underpriced relative to the value it provides, and raising prices over time.
So they plan to keep raising prices,
Yeah.
even with this scrutiny.
They say they will, but importantly, they add they'll do so in a predictable way to avoid shocking the system. They want to manage expectations.
But the FHFA's decision to allow competition, how does that impact their pricing plans?
Well, that's the crux of it. The FHFA's decision, according to many analysts we reviewed, is seen as potentially reducing the regulatory barriers for competitors like VantageScore. And as a result, it likely caps FICO's pricing power over the long term.
Meaning they might not be able to raise prices as aggressively.
Exactly. It could lead to a slower trajectory for price increases moving forward. It effectively introduces a competitive check that wasn't really there before in the conforming mortgage market.
So even if $4.95 is small relative to $6,000.
Right. While that $4.95 might seem like a small fraction, the optics of those significant percentage increases can attract intense regulatory attention, especially when a company holds such a dominant market position in a critical sector like housing. It's that classic tension between perceived market value and public affordability concerns.
Okay, so with all these pressures, the competition, the pricing scrutiny, the predictiveness debates, what's the immediate future look like for FICO in this high-stakes environment with the FHFA? How are they navigating these regulatory cross-currents day to day?
Management is clearly taking this situation very, very seriously and is actively engaged on multiple fronts.
What are they saying and doing?
CEO Lansing repeatedly emphasized in his interviews and calls that the FICO score remains the deeply embedded industry standard. He points to that 90% usage by top U.S. lenders, the integration into models across the entire financial ecosystem.
Reinforcing the Moat argument.
Exactly. He argues forcefully that switching to VantageScore would necessitate significant retooling across this vast network. It would disrupt risk models that have been refined over decades and could fundamentally undermine safety and soundness in the massive, interconnected $12 trillion U.S. mortgage market.
The message being, switching is risky and expensive.
That's the core message. The cost and risk of switching are far greater than any perceived benefit, especially if the alternative isn't as predictive.
And FICO isn't just passively waiting, right?
Yep.
They're actively pushing back against the FHFA's process.
They are. They're not sitting on their hands. They have publicly urged the FHFA to release its comparative analysis white paper. FICO firmly believes this analysis would demonstrate FICO 10T's superior predictiveness over the other scores currently under consideration, including FICO Classic and VantageScore.
Asking for transparency.
Essentially, yes. Show us the data that supports your decision, is the subtext.
Have they met with the FHFA leadership?
Yes. Direct discussions have taken place with FHFA Director Bill Pulte. Lansing noted in his Bloomberg interview that Pulte is a man of action who wants to move quickly. So the dialogue is happening at the highest level.
And Lansing expressed confusion about FICO 10T being excluded.
He did. He expressed genuine puzzlement as to why FICO 10T, which again he asserts was recognized by Fannie and Freddie themselves in prior evaluations as the most predictive score, is not included in the FHFA's interim implementation for lender choice. He sees this exclusion as a missed opportunity for greater efficiency and risk mitigation for the whole system.
But here's the crucial question, maybe the bottom line for now.
Yeah.
Have any lenders actually switched since the announcement?
Ah, yes, that's the million-dollar operational question. And according to FICO management, as of their latest updates shared publicly, no lenders have switched to VantageScore since the FHFA announcement.
Zero switches so far.
That's what FICO reported. Now, it's still relatively early days, but that's a very significant detail amidst all the regulatory noise and market reaction.
What does that suggest?
It suggests that while the option now exists, the entrenched nature of FICO, the immense operational lift required for a switch, the potential disruption to existing models, and perhaps the belief in the proven predictiveness of FICO scores. All of that is currently holding sway with lenders.
Inertia is powerful.
Inertia is incredibly powerful, especially in complex, regulated systems. The path of least resistance and perhaps greatest perceived reliability still seems to be with FICO, at least for now, in the mortgage space, but it's definitely something to watch closely.
Okay, let's pivot back now. While the scores segment is clearly the powerhouse driving FICO's exceptional financial results, let's turn our attention back to FICO's software business. We touched on it earlier. It tells a somewhat different, more nuanced story, doesn't it?
It really does. It's a crucial distinction we need to make as we analyze the company. What becomes clear from our sources is the contrast in growth rates. The software segment's growth rate of just 3% year over year, well, it's relatively modest.
Especially compared to scores at 34%.
Exactly. And also, when you compare it to the often high double-digit growth rates you see with dedicated SaaS peers in the broader software market, it's just not keeping pace.
And other parts of the software business were slow, too.
Yeah, we saw that expansion in professional services and traditional on-premises software revenue was limited. That suggested deceleration in some of the legacy areas.
Okay.
Furthermore, the annual contract value, or ACV, bookings for Q3 2025, that's new business signed, came in at $26.7 million. That was actually slightly below the $27.5 million from the prior year.
So new software sales dipped slightly.
Seems so. Which could imply, as some reports suggested, a more cautious IT spending environment among their clients, maybe financial institutions tightening their belts a bit due to broader economic uncertainty.
But the software business is still very profitable.
Right. Oh, extremely profitable, boasting impressive mid-50% margins, which is fantastic, but its growth trajectory is clearly not mirroring the dynamic acceleration seen in their scores division.
Highlighting a strategic area that needs focus.
Absolutely. It's profitable, but it's a slower-moving part of the business right now. It requires focused attention and investment from the company to perhaps re-accelerate.
Now, digging into those software numbers a bit further, you mentioned earlier there's a notable difference in performance within the software segment between newer platform solutions and maybe more traditional offerings.
Yes, this internal dynamic is really revealing. It signals a very clear strategic pivot happening within FICO's software division.
What's the breakdown look like?
Okay, so total software annual recurring revenue, ARR, grew by that modest 4% year over year overall. But it's the underlying components that tell the real story.
Go on.
Their platform ARR, presumably their newer integrated cloud offerings, demonstrated much stronger momentum. That grew by an impressive 18% year over year.
18%, that's much better.
Much better. And it was coupled with a dollar-based net retention rate, or DBNRR, of 115%.
EBNR, remind us what that means.
A DBNRR above 100% means that your existing customers from a year ago are spending more with you today. So 115% DBNRR indicates strong product stickiness and expansion within their client base for these platform solutions. They're successfully upselling or cross-selling to existing platform customers.
Okay, so the platform stuff is growing well and customers are spending more. What about the rest?
Well, in stark contrast, the non-platform ARR, likely their older legacy software products, actually saw a 2% decline year over year.
A decline.
And its DBNRR was only 97%.
Below 100, meaning existing customers are spending less.
Exactly. A sub 100% DBNRR means that existing customers in their legacy software products are either reducing their spend or churning altogether. It reflects a contraction in that part of the business.
So this trend really highlights the strategic shift.
It vividly illustrates where FICO sees its future, doesn't it? A determined shift towards more integrated, scalable, cloud-native platform offerings. While the legacy software seems to be seeing some planned or perhaps natural contraction as resources and focus are reallocated.
Okay, So what's the overall takeaway here? FICO isn't just ignoring these growth challenges in their software segment. They seem to be actively investing in and positioning for future growth, recognizing the need to modernize and adapt.
Exactly. FICO is clearly not content to let the software segment just, chug along at 3-4% growth. They're making significant strategic investments to try and reignite it.
What kind of investments?
Well, at FICO World, which is the company's big biennial user conference, FICO showcased its next generation FICO platform. This new platform is designed to be a more comprehensive, integrated solution for financial institutions.
What does it promise?
It promises several key advancements, things like improved real-time decisioning capabilities, allowing banks to make instant, data-driven decisions on everything from loan approvals to fraud detection.
Faster decisions.
Right. It also features integrated fraud solutions, which are increasingly critical in today's digital world. And they announced a new marketplace for enterprise intelligence, where financial institutions can supposedly access and deploy a wider range of FICO's analytical tools and maybe even partner solutions more easily.
So trying to broaden the scope beyond just scoring.
Definitely. These initiatives are designed to expand the utility and reach of their analytical prowess beyond just credit scoring into broader enterprise decisioning, risk management, customer management, the whole life cycle.
And they're not going it alone in this push, are they? I remember reading about a partnership with a tech giant.
That's right. FICO also announced a significant agreement with Amazon Web Services, AWS.
AWS, okay, that's big.
It is. They plan to co-market this new platform with general availability slated for the second half of calendar 2025.
What does that AWS partnership really do for them?
It's a crucial strategic move, I think. Leveraging AWS's massive cloud infrastructure, their global reach, their established customer base, it can significantly boost the platform's reach and adoption, much more than FICO could likely achieve on its own.
Gives them scale and credibility.
Exactly. It signals FICO's commitment to cloud-native solutions, which offer the scalability, flexibility, and cost efficiencies that modern enterprises demand. This collaboration could accelerate FICO's penetration into new markets and provide a robust foundation for their next-generation offerings, helping overcome some of the traditional barriers of selling complex, on-premises software.
Makes sense. Additionally, FICO isn't just relying on traditional software, even cloud software. They're also leaning into the cutting edge, right? Previewing proprietary AI models.
Yes, and this is where FICO's deep analytical expertise built over decades could really shine and differentiate them. They previewed proprietary AI models.
What kind of AI?
Things like foundation models, language models, sequence models, but importantly, specifically designed for high-stakes decisioning in financial services.
Tailored for finance, not just general AI.
Precisely. Think about that. These aren't general-purpose AI tools like you might find elsewhere. They're supposedly tailored for the unique complexities, the regulatory demands, the need for explainability in banking, credit, and risk management.
So, connecting this to the bigger picture.
FICO's strategic investments in AI, these advanced cloud-based platforms, and that powerful AWS partnership, it all demonstrates a clear intent to leverage their deep analytical expertise beyond just credit scoring.
Diversification.
Yes, diversification and modernization. These are crucial initiatives for long-term growth and could potentially reinvigorate software growth. However, it's important for you to note, as analysts pointed out, these are currently unproven and will require execution to translate into material revenue.
Potential is there, but they need to deliver.
Exactly. The successful development and adoption of these initiatives will be absolutely vital for the software segment's future trajectory and its contribution to FICO's overall growth story. It's a significant long-term play, not an overnight fix.
Okay, let's move into the final stretch here. Given everything we've discussed, the stellar financials, the big regulatory headwinds, the strategic pivots in software, you might be wondering, how are investors actually reacting to all this? It's been a bit of a roller coaster ride for FICO stock lately, hasn't it?
It really has. And this is where the market's perception truly meets the underlying business reality, raising important questions for you as an investor trying to value the company.
How's the stock actually performed?
Well, as we mentioned, FICO stock is down significantly in 2025. Reports said 22% year-to-date at one point, and it's over 42% down from its all-time highs reached back in 2024. That's a major correction.
42% off its highs. Wow.
The company still holds a substantial valuation, though around $32.68 billion market cap recently.
And how has it been viewed historically by analysts?
Analysts have historically viewed FICO as pricey, It often traded at a very high price to earnings, or PE ratio.
Why so high?
That premium was largely attributed to its near monopolistic nature in the credit scoring market, that powerful moat we discussed. Investors were willing to pay up for that dominance and predictability.
And where does the valuation stand out after the drop? It's
Yeah.
still high.
Its forward PE ratio was recently cited as being around 37, which, yes, is still considered high by many traditional metrics. You often hear a general preference for less than 30, maybe even less than 20, for value investors.
So still expensive even after falling 40%.
Relatively speaking, yes. This current valuation reflects a real tension, I think. While the recent earnings are undeniably strong, that regulatory uncertainty and the potential for increased competition are factoring heavily into investor sentiment.
Pricing in the risk.
Exactly, potentially leading to a reevaluation or a re-rating of its long-held premium multiple. The market is trying to figure out, how much is that moat worth now with these new challenges?
Now, despite this stock dip and the market's obvious nervousness, FICO's management has been doing something quite bold,
Yeah.
aggressively buying back shares.
They have indeed.
This move often signals strong confidence from leadership, right, betting on their own company. But it's also drawn some criticism, creating an interesting debate among investors.
It certainly has. What's crucial to understand here is the scale. In Q3 alone, FICO repurchased 284,000 shares of its own stock for more than $500 million.
$500 million in one quarter.
Yes. This aggressive capital allocation signals management's profound confidence in its underlying cash generation, which we saw was record-breaking, and their belief in the long-term value of the company, especially when they perceive the stock to be dislocated or undervalued by the market.
Did the CEO comment on this?
He did. Will Lansing was very clear about this strategy. He said, quote, "We think FICO stock is a great value at $1,800 or $1,900 or $2,000, $2,100, basically implying at recent levels and even higher." He added, "We try to be in the market kind of all the time with regular purchases to use up our cash flow and maintain our leverage at kind of a comfortable level."
Using up cash flow and buybacks.
It's a testament to their conviction in FICO's intrinsic worth. They think buying their own stock is the best use of capital right now.
However, this strategy isn't without its detractors, is it? Some critics point to the fact that FICO has been raising debt to buy back all these shares,
That's the criticism, yes.
which has apparently resulted in a non-existent equity ratio on their balance sheet because they've used significant amounts of debt to finance these buybacks over time.
Mm-hmm.
And this is particularly concerning to some, given that some of these buybacks occurred when the stock was trading at much higher prices, before the recent dip, buying high with debt.
This is a legitimate point of contention for some investors, absolutely. While buybacks can be a powerful tool for shareholder returns, the strategy of increasing debt to do so, well, it definitely adds a layer of complexity and financial risk for you as an investor to consider.
It changes the risk profile.
It affects the company's balance sheet, increases leverage. FICO, for its part, reiterates its target leverage ratio of 2-3 times EBITDA. Management believes this target leaves ample room for additional buybacks, especially, as Lansing said, when the stock is dislocated from what they see as its true value.
So it's a calculated risk from their perspective.
A calculated risk management and capital allocation strategy, yes, but one that clearly involves taking on debt.
Now, here's where it gets really interesting for observers, I think. We see some of the market's most respected super investors, those high-conviction, long-term players taking different, often quite committed, stances on FICO. It offers a fascinating glimpse into varying conviction levels.
It really does. This highlights the divided opinion even among seasoned, supposedly smart money investors, which is always an insightful dynamic to watch.
Who are we talking about?
Well, for instance, Dev Canisaria of Valley Forge Capital Management, he notably holds an enormous amount of FICO stock. Reports indicated it represented a staggering 31% of his entire portfolio at one point.
31% in one stock. That's huge concentration.
Massive concentration. And importantly, he held onto this position steadfastly through that recent dramatic drop in share price. That signals continued deep belief in the company's long-term prospects.
But could he buy more on the dip?
Apparently not easily. Reports suggested he was almost fully invested, with less than 1% cash. So while he held, he couldn't necessarily double down during the dip, which is a key constraint for concentrated managers sometimes.
Any other examples?
Similarly, Altarock Partners, led by Mark Massey, is another well-regarded firm known for concentrated portfolios. They also hold FICO, placing it alongside other high-quality, resilient companies like Google, Visa, Microsoft, and Amazon in their select group of holdings.
So grouping FICO with those tech giants and payment networks.
Exactly. It suggests that despite the short-term noise and the very real regulatory concerns, some prominent investors with a long-term fundamental view still see profound intrinsic value in FICO.
What might they be seeing?
Perhaps they're betting on the enduring strength of its core moat, the sheer difficulty and cost of truly displacing such an entrenched standard, and its proven operational excellence and cash generation. Even if future growth is maybe more moderated due to these external factors, they're looking beyond the immediate headlines, potentially years down the road.
Fascinating to see that long-term conviction amidst the short-term turmoil. Okay, looking at the overall outlook for FICO then, we've covered a lot of ground today. Let's try to summarize. What would you say were the key positives that went well for FICO recently, based on our sources?
Okay, the positives. FICO's Q3 results truly demonstrated robust revenue growth, right? And significant non-GAAP EPS expansion. That powerfully highlights strong underlying demand and continued pricing power, especially in its core scores business.
Record cash flow, too.
Huge positive. The company generated record free cash flow, raised its full-year profit guidance, and strategically engaged in those aggressive capital returns through share buybacks, signaling management's confidence. The Scores segment continues to show impressive momentum with innovations like FICO 10T and the new BNPL scores, demonstrating they're not standing still. And looking forward, there's also that promising pipeline for next-generation platform solutions in their software division, the AWS partnership, the AI initiatives.
Lots on the positive side of the ledger.
Definitely. These are all strong indicators of a healthy, well-managed, and forward-thinking company in many respects.
And on the flip side, what should we, and you, the listener, be watching closely moving forward? What are the key risks and challenges that FICO really needs to navigate successfully?
Okay, the watchouts. The software segment's growth trajectory remains, well, tepid, right? Lagging behind high-growth SaaS peers. Successful execution on those new platform initiatives, the AWS partnership delivering, that will be absolutely critical to turn this around and realize its full potential. That's a big execution risk.
And the regulatory cloud.
That's probably the biggest one right now. The regulatory and competitive risk from the FHFA's lender choice decision introduces significant uncertainty around FICO's future pricing power in mortgages, and it opens the door to potential, albeit likely modest initially, market share erosion in that crucial sector.
Dependence on mortgages is also a risk.
Yes. FICO's continued heavy dependence on mortgage volumes means that things like elevated interest rates, persistent housing affordability challenges, those could pressure revenues in the future if the overall mortgage market contracts significantly. They're exposed there.
And valuation.
Finally, yes, despite the recent stock dip, FICO still trades at what many consider a premium valuation. It requires sustained operational performance, successful navigation of these regulatory and competitive challenges, and compelling execution on their software strategy to justify that premium for long-term investors.
The central question is?
I think the central question for you is, how does FICO, a company with undeniable strengths and an incredible historical market position, strategically balance its established dominance with the undeniable need to innovate, adapt, and respond to this evolving regulatory and competitive landscape? It's a complex equation, and how they solve it will define its future trajectory.
Okay. Today, we took a really deep dive into FICO, a company that, as we said at the start, continues to present this fascinating duality.
Absolutely. Two sides to the coin right now.
We saw a company posting impressive Q3 financial results, largely driven by the sheer strength and pricing power of its Scores segment, particularly fueled by that surge in mortgage origination revenue.
The numbers looked great, mostly.
Yet, beneath these strong numbers, we uncovered significant competitive and regulatory pressures, especially from the FHFA's lender choice decision and that ongoing high-stakes debate with VantageScore over predictiveness and market standards.
That's the shadow hanging over the strong results.
We also explored the potential of FICO's software innovations, the new platform, the AI, the strategic pivots, even as that segment faces its own distinct growth challenges compared to Scores.
Right. A work in progress there.
It really feels like a company at a pivotal moment, doesn't it?
It really does. The dynamic tension between FICO's deeply embedded market position, that almost unparalleled moat, and these external forces attempting to introduce more competition, scrutinize pricing, redefine market standards. It's a powerful and unfolding narrative in the financial world. It kind of encapsulates a lot of what's happening in other regulated industries today, too, this push and pull.
So what does this all mean for you listening in? as a participant in this credit ecosystem, FICO's story is clearly far from over, and it's a fascinating one to watch as it navigates these powerful cross-currents.
Absolutely. Stay tuned on this one.
As you think about the future of FICO and maybe the broader credit ecosystem, consider this. In an era where data is increasingly called the new oil, and precise, reliable credit decisions are more critical than ever for both lenders and borrowers, how much is real, verifiable, predictive superiority truly worth? Especially when it's weighed against the desire for increased competition, for reduced costs, and for broader access to credit.
That's the core tension right
Yeah,
there.
maybe even more fundamentally, who ultimately bears the risk when those decisions about which scoring models to trust diverge across the financial landscape? Is it the lender, the GSE, the taxpayer, the borrower?
The powerful thought for you to mull over. The delicate balance between innovation, established market dominance, predictive accuracy, competition, cost, and the public interest. It is always a complex one, and FICO, a name we all recognize, is right at the very heart of that balancing act today.